Well, welcome everyone. Before we get started, can we take a minute just to acknowledge our sponsors? You'll see their details on screen here, in particular, recognising Partners Life, who are the sponsors of today's session. And the ReGenerations conference is only made possible with their generous support. Good afternoon, everyone. Thanks for joining us. I'm Nick Summerfield. I'm facilitating this afternoon's session. I'm a partner at law firm Anthony Harper, and I lead our financial services team, broad financial services practice, and work with clients of all sizes on licensing matters and contemporary issues like conduct and culture, as we're discussing today. I'm recognised by Legal 500 as a leading individual and ranked by both chambers and partners and by best lawyers. So today's session is CoFI in Focus. We'll be discussing implementing the conduct of financial institutions legislation and the challenges it holds for the sector. Format today is a facilitated panel discussion with some time for questions at the end. I'm sure by now everyone's very familiar with Zoom, but if you're not, there's a QA function and a chat function at the bottom of the screen, which you're welcome to use. So, introducing today's speakers to you all. We have a diverse panel of speakers from a range of backgrounds, industry participants, a regulator and professional advisors, and I'd like to introduce them to you now. Starting with Clare Bolingford. Clare is FMA's Director of Banking and Insurance Conduct. She leads the FMA's work to implement the expected, or probably now pending, conduct regime for banks and insurers. Her role has a significant focus on engagement with key stakeholders, including relevant government departments, other regulatory agencies and the financial services industry. Clare previously worked for the Financial Conduct Authority in the UK for almost 20 years in a variety of supervision and policy roles, including leading and implementing regulatory change programs, and she spent 2 years at the UK Treasury leading capital markets and prudential policy. Next up is Steve Burgess. Steve is a director of the Compliance Refinery. He has an Honours BCom with a major in finance and a minor in economics. Steve started Compliance Refinery 3.5 years ago and has successfully grown the company over that period. He has 17 years experience in compliance and risk management across Canada and New Zealand. He worked at the regulator in Canada and has been seconded to FMA while in New Zealand. Steve began his career in financial services as a financial advisor on a portfolio management team. Amy Cunningham is the Head of Conduct and Culture at AIA. Amy's a fellow lawyer. She moved into this area from a previous role of Head of Regulatory Affairs at AIA last year, recognising AIA's commitment to setting high standards of conduct and culture across its organisation and the wider industry. As well as being responsible for the operation of AIA's internal conduct framework and embedding the FSC's Code of Conduct, Amy is leading AIA through its preparations for CoFI. Next up is Becky Mcclelland. Becky is the Chief Risk Officer at Partners Life. She has over 20 years' experience in financial services with a broad-based work experience, including senior and leadership roles across Line 1 and 2 risk and compliance, governance, in-house and consulting. Becky's experience lies in understanding and implementing regulatory change, designing and enhancing risk management and compliance assurance frameworks, and working with businesses and boards to formulate and articulate risk strategy and risk governance. Becky's a financial advisor and she's a member of the Code Committee. Last but not least is Tim Williams. Tim is a partner at Chapman Tripp. He's a leading commercial lawyer who established Chapman Tripp's financial services team. He's sought after for his knowledge, commercial and practical experience, particularly in investment funds, insurance, investment products, financial services and banking. And he has a broad range of practical experience, including commercial law, licensing, compliance, mergers and acquisitions, anti-money laundering, overseas investment restructuring, takeovers and NZX listing. Before we open to the panel, I thought it would be helpful to take a couple of minutes to set the scene with a quick refresher of what the conduct law involves. So, as I say, a quick refresher, but useful to set the scene. CoFI will apply to registered banks, retail insurers and non-bank deposit takers, all of whom will be required to obtain a conduct licence from the FMA, in addition to the other activity-based licences they need. So, for example, as an insurer. In a sense, it's a natural progression from FMA's earlier work on conduct, from the Australian Royal Commission, and of course from the FMA and Reserve Bank reviews of banks and life insurers. CoFI is a principle-based regime centred around a fair conduct principle, which will require a financial institution to treat its customers fairly. Principles are operationalised through detailed fair conduct programs, which will be required to cover a broad range of matters set mainly by the bill or the Act, but also by regulations. CoFI will also limit payment of incentives. There is still uncertainty on this as we wait for regulations, but the most likely scenario was probably a blanket ban on volume and value target-based sales incentives. And as most of you will know, the other main area of uncertainty concerns the extent to which financial institutions will be responsible for their intermediaries. There were significant changes here when the bill reported back from Select Committee, and there has been further consultation since then. My understanding of the current position is that MB are progressing with a narrower definition of intermediary, which will be linked to those involved in sales and distribution. And the MB are moving away from imposing obligations on financial institutions to manage, supervise, or monitor intermediaries. And instead, there'll be general principles guiding the oversight of intermediaries, which MB expects will be reflected in policies, processes, and arrangements within a financial institution. So, for example, these will include, or are expected to include, I should say, acknowledging financial institutions are responsible for whether customers are receiving fair outcomes, regardless of the channel distributed, and that financial institutions should take a proportionate, risk-based approach when designing policies and systems for distribution. So these changes will ultimately be reflected in an SOP to amend the bill. I understand that's likely to be available in Q2 next year. Time frame for the bill itself is around July 2022, expected passing date. And then indications are that licensing will open in July 2023 with commencement from July 2024. So, having set the scene, I'd like to pass over to our panellists, and to kick things off, I'd like to invite Clare to tackle the first question, which is, how is FMA preparing for implementation of CoFI? What approach will you take, and what will you be offering in terms of guidance or workshops for financial institutions? Clare.
Kia ora, Nick, and tēnā koutou katoa. So yes, in terms of preparing for implementation, the FMA has established a dedicated team and a wide-ranging programme of work across the organisation to support the implementation of CoFI. So this programme of work consists of various work streams. For example, projects include developing our licensing approach, our monitoring framework, and also our model for engaging with industry and other agencies such as the Reserve Bank and also the Commerce Commission. Now, we're still working through options for the approach, as you can imagine, but we do have some core elements that we expect to be part of it that I wanted to run through today. So first of all, we absolutely want to work with industry through constructive engagement and take industry on this conduct journey with us. And this means that we will be seeking to engage as early as possible, whether that be through workshops or whether that be through consulting on more formal guidance. And one of the first aspects that we want to engage on next year will be the licensing approach itself. And we have heard the feedback from the financial advice licensing process that timeliness of guidance and also consultation is really important to industry. So we are intending to publish the licensing guide and consult on standard conditions as soon as we're able to after the legislation has passed, which is expected, as Nick said, to be around the middle of next year. And we're also intending to use the best and most suitable parts of the financial advice approach in licensing as well. Obviously, this is a somewhat different population, and I'll come on to that in a minute in terms of some of our considerations for that. But nonetheless, we feel that we've learned a lot through that process and getting feedback from another sector. And obviously, there are many in the sector who are not only going to be part of CoFI, but also part of that financial advice regime. But in addition to licensing, we also want to talk about the other aspects of the implementation, including that monitoring framework, and particular areas of final policy that might require more guidance from us for implementation to go well. One of the key elements of the regime itself that we're looking to as we're considering the approach is around proportionality and also around a risk-based approach. And again, using our licensing considerations around licensing as an example of this, we'll be thinking about things like recognising those entities that have existing prudential licences with the RB. So obviously everybody coming into CoFI will have one of those, and we'll be working closely with the RB to consider how that then applies through into conduct licensing, and potentially also those who have other licenses with the FMA, what information we already have, so that we don't need to repeat anything or ask for things again. It will be a tailored approach depending on entity type, and also will mean that we will scrutinise in that risk-based approach business models differently, and firms themselves in terms of the risk posed to consumers, the risk of harm to consumers. And that's all likely to flow through as well into our monitoring approach, which is also intended to be proportionate and risk-based, to take into account particularly the size and the nature of individual businesses. It's very much our intention as well to identify and promote good practice as we go through the implementation period and in the run-up to the regime coming into force. In particular, during those initial years from next year onwards, we do want to be educative, and this will include sharing with industry our insights on what we think is being done well, and we'll also continue to point out where things haven't worked well, particularly if we're seeing trends across more than one firm. But what we're hoping to achieve by all of this is influencing a change in mindset and culture. So focusing on those principles, or the core principle, around fair conduct rather than rules. And this basically means that what we're not expecting to see is firms just putting in place a compliance checklist and expecting that to be enough. So we don't think that's going to cut it under CoFI. And while our monitoring approach will, of course, seek to call out breaches where they do occur, and take action where firms have fallen short, what we're expecting to see is this ongoing focus on those fair customer outcomes, and not just the specific rules within the legislation that need to be in place. So we view embedding good conduct as a long-term journey that will require behavioural changes over time to get right. And that means changes for the industry, but it also means changes for some of the ways that the FMA itself operates as we take on more responsibilities under this regime. It does mean that we're open to feedback, and we're open to learning as we go. So that's just a quick summary of where we are now. But we are keen to hear from the industry, and we'll be continuing, we hope, our discussions in the new year with you on that. And I'm really keen to hear from other members of the panel about their views on implementation and some of the challenges being considered. So back to you, Nick.
Thanks, Claire. Yeah, I mean, and that's a good time to bring some panelists in, because it's pretty clear that there's a lot to do. So first question to kick off then is what can or should financial institutions be doing now to prepare for CoFI? And I'd ask Amy to comment first on that.
Yeah, thanks, Nick. And thanks for that summary, Claire. That was really helpful. So just firstly, at AIA, we're really supportive of the changes that CoFI will bring to our industry. I think we recognised pretty early from learning from both the Australian and the UK experience the need for good conduct principles to be embedded within our organisation. And so that's why about 3 years ago we developed a conduct framework for our organisation and launched that with quite an intensive awareness campaign. All new joiners still must complete mandatory conduct training. So that will be, of course, updated where it's needed in terms of CoFI once that lands. The tone from the top is really important for organisations, and at AIA we believe that doing the right thing in the right way is how we really need to move forward. This really does start with our board and management teams. So as part of that, what some of the things we do is we regularly report to our board on key conduct metrics across the different areas of the business. And this is something that the FMA has flagged is going to be a focus of theirs moving forward to ensure that financial institutions are really measuring those impacts of the actions that they've taken as part of the conduct and culture review a few years ago. Over the past year, we've also been trying to increase awareness across the organisation of CoFI, and we've been doing that by holding smaller sessions with teams and really focusing on the likely impacts for those teams with what we know already about the CoFI bill, and really, focusing on what it will mean for them to get that engagement up. And we've also been trying to apply that new fair conduct principle now to new initiatives and processes, and really ensure that these are appropriately future-proofed and that we are truly prioritising our customers' interests. A couple of examples of that would be ensuring that there are conduct gates in our business scorecards, making sure that they are in product reviews, and having a designated committee with executive level leadership focusing on advisor conduct. We've also included good conduct principles through our financial advisor agreements as well. I think one of the challenges is certainly going to be resourcing. And of course, I think every financial institution needs to ensure that they are allocating sufficient resourcing now, or at least thinking about that, just to ensure that CoFI's implementation will be successful in their organisations. What we've been doing, we set up a dedicated conduct and culture function last year, and since then we've been also in the process of setting up a dedicated project team to deal specifically with CoFI and looking at almost a gap analysis of different areas of the business and the likely impacts. Finally, the last thing I would say in terms of things that could be done would be to do that gap analysis early, to get the right people in the room across the organisation, and really to start just driving that engagement. And I think that's going to be something that will really put you and your organisation in a really good stead for CoFI's implementation next year.
Thanks, Amy. Some really good points there. Tim, I wonder if you've got some comments from a lawyer's perspective.
Yeah, no, I think what Amy said is a very good description of an organisation that is well organised, for the preparation of this legislation. I think the first point to raise here is the point you already mentioned, though, that we're going to get enactment in July next year, so. It's almost a case of keep calm and carry on the good work that insurers and banks have done already in responding to the RBNZ FMA's conduct and culture reviews, because in some ways you could regard this as being the cart before the horse. The compliance components that have been imposed through that review or encouraged through that review are really the sorts of behaviours that the legislation is designed to reinforce. So in many ways it's going to be carrying on what's been done already against the Royal Commission. There's been gap analyses done and action plans developed. Recognising, of course, when the time comes, and that's going to be in 2023, so still a way away, there'll be need to document all of the procedures, policies, systems and controls. And it will be important when you get to that stage to be able to demonstrate all of the compliance that is being undertaken. So what reasonable steps are being taken to ensure that effectively customers get good customer outcomes, suitability of the products that are being designed. A lot of this is, and the descriptions, as you'll see when you look at it, are very much around, customers' expectations being met. And that's sort of a translation of good customer outcomes. So I think that's those are the sort of key steps. I think, everyone's got a bit of time, but in the preparing now is going to put you in good stead when the time comes. Secondly, the other aspect, of course, is all around incentives, and this is platform legislation, which really means that we're going to know what the detail is when the regulations come in and what's being imposed. At the moment, the indications from the minister and hopefully and during the engagement on this process have been largely that maintaining linear commissions will be acceptable. So making sure that it's a fixed percentage, there aren't hurdles and steps. and anticipating that that's going to be something in the future that's going to be mandatory if you're not complying already with that. So there is possibility of further regulation coming, but we just don't know what that is at this stage, or whether that's going to occur, to really prepare for any of that. And as Amy said, conduct gates are an important part of ensuring that good behaviours are reinforced. We are waiting still on the intermediaries amendments and what's going to come out of that. So at this stage, it's probably too early to plan entirely what steps are going to be taken to record these things. But when the time comes, that might lead to documentation with intermediaries reflecting powers to enable the financial institution to enforce the requirements. So those are the sort of key things I think that the people should be thinking about now.
Thanks, Tim. So, the conduct regime is new in New Zealand, although it builds obviously on earlier work, but there is overseas examples. So next question I'll direct to Clare first and then to Steve, and that's what experiences there been overseas that might be helpful in preparing for the regime, and developing your fair conduct program.
Thanks, Nick. So yeah, there's a whole wealth of information out there, I think, from what others have done, and Amy touched on it really at the beginning in terms of looking at the experience of the UK, of Australia, and I'd also probably point to Singapore, who are doing some interesting work as well, particularly around digitisation and the use of technology to support good conduct too. So I think I'd probably say, in response to some of that and some of the experiences that I had when I was regulating in the UK post the GFC and some of the poor conduct that we saw that emerged over time there, was really focused back on the basics first. And this is to prevent some of those common problems that occur if you don't have that really good foundation in place. That's something that we've seen through our culture and conduct reviews. I would say time and time again with the different reviews that we've put in place is that often, if there hasn't been proper investment in systems or in thought put into controls and processes to avoid conduct risk occurring, then that can be when you fall down. So I would say manual processing is at the root of a lot of issues that we see. And so getting those foundations in place are really crucial. And then moving to embedding some of those good practices that Amy was talking about and that we have seen in other jurisdictions and are beginning to see here around good governance, really strong accountability so that people know what they're responsible for in the conduct risk management process, gathering information to make good decisions on your risk management, and using different indicators that's suitable for your business to support fair outcomes and pick up on any issues early. So really moving from getting those foundations in place and reactive conduct risk management through to more proactive approach to it. I guess I'd also pick up on there's quite a lot of work out there from various different jurisdictions and places on culture and how that supports good conduct outcomes, and also behavioural insights, because conduct is about behaviour over time within an institution. So, and there's quite a lot of material out there around the importance of psychological safety and how to encourage people to speak up. So actually you get a really good feedback loop going sort of from the front line and right through up to decision makers, executives and boards around what's really going on in practice and what customers are actually experiencing. So there's probably a couple of things that I'm listening to or reading at the moment that I'd call out, not particularly for an endorsement, just because I'm interested. So one's more on the banking side, but I think is really relevant as well to insurance, and is from the New York Fed. It was called out in the Financial Times article this week, actually, by Gillian Tett, who spoke about their podcast, which is all about culture and has various different speakers on that. And I'm all into podcasts at the moment and kind of listening to different people's views on things. And I'd also recommend Human Risk, which has a podcast as well, which talks quite a lot about compliance and compliance culture and risk management, which is run by my ex-colleague at the FSA in the UK, Christian Hunt, and has quite a lot of interesting information about behavioural insights and behavioural science and how that applies to conduct. as well. So I'll probably leave my list of recommendations there, but there's a lot of information out there if you want to go looking for it. And certainly what we see as some of the good practice that's being implemented here in New Zealand is really taking the best of that and thinking how it applies in the New Zealand context and how it applies particularly to the institution that's bringing that in.
Over to you, Steve.
Thanks. That was a lot of great information, Claire. I will try not to touch on some of that specifically, but having worked in regulation in Canada, it was quite interesting when you're talking about culture change. One of the biggest things that changed the quickest in Canada was when they had a very clear line of who was responsible for any act. And individuals were specifically registered with the regulator, and the regulator, they were the end of the line. There was no pushing it down to middle management. I can say for those of us in senior roles at that time, changed our world very, very quickly. It was incredibly effective. I would say also from our perspective, having been in Canada at a time when there was a couple of significant regulatory events, one of the biggest things we did and one of the most effective things we did as a regulator was constantly reassessed our own effectiveness, which was at times a bit sobering, to be honest, especially after the Bernie Madoff scandal, which there was a lot of key learnings that came out of that and significant change. But more in relation to New Zealand and how you can change your culture, how you can focus in New Zealand, I would say coming to New Zealand, one of the biggest surprises was the lack of investment in technology and data analytics. It was a significant surprise. And I think we're starting to see that now, where people aren't using it as an excuse to keep something hidden, because I think in certain boxes, people knew that maybe they didn't want evidence to know certain things. And we're starting to see that come out now, which is fantastic. So if you're thinking about what those first steps are and you're understanding what those first steps are, we always, in Canada at the time, we had very much a customer focus, and suitability was a word that came up often. It was just ever present in anything you were talking about from a regulatory perspective, whether it be a product or whether it be a suitable situation for a client. And sometimes I think we get a little bit lost when we talk about good customer outcomes, and we tried to define them. And what I would say is you're just looking for a suitable product that fits an individual customer. And that's what all entities should be focused on, and going away from kind of, I think when I got here, I learned the term set and forget. But going away from these models, building for the life of a client, and what does that look like? How do you service a client over a long period of time? People's lives change very significantly. So I would say going down and looking at your technology systems and how can you learn more about your clients? How can you identify potential risk points for your clients? How can you identify when your clients likely need to be serviced? And those are all things I think that you should be tangibly looking at right now for any entity that's got a number of clients, looking at how to meet those suitability requirements and how to ensure each individual has the highest likelihood of a suitable outcome. I would say those are great areas to focus on right now.
Great, thanks, Steve. Thanks, Claire. So a lot has been made of the impact of CoFI on advisors. Clearly, the position of intermediaries has been a very topical issue. Next question is, what do you see the impact being on advisors from disclosure and other changes? Do we think it's, incentives and other changes? Do we think it's going to be a significant upheaval, or do we think advisors will take it in their stride? And I'll call on Becky first and then Amy.
Hi there, thanks Nick. So when I was thinking about this question, I actually wanted to take a bit of a step back on it and think about actually how much change is there in the bigger picture, not just for advisors, but for everybody. And I think it's fair to say that there continues to be a substantial amount of regulatory change that we're all dealing with, whether that's in industry or smaller advisor firms. We've got the new financial advice regime and CoFI as well, and those are naturally linked, but they are change on change. So thinking about this from an advisor's perspective, I think the amount of change that we're seeing is significant for those small to medium-sized advisor businesses. And we really need to be conscious of that, because we're loading up more and more onto those organisations, but perhaps not necessarily seeing it from their perspective and being in their shoes. So, when we think about them needing to comply then also with a fair conduct program, we need to think about, well, what does that actually mean? Do they need extra time to adapt, to invest in extra technology or resources, and also to adjust to the new financial advice regime, which is what they're currently trying to do now? So I think, I thought about that at first as the context that we're trying to work with advisor firms with. Having said that, I think the majority of advisor businesses that we see at Partners Life are adapting really, really well. Some do have some challenges still, and they're working through those with the product providers and FMA as well. And I know that FMA, listening to Clare, is trying to support those advisor firms. Thinking about the disclosure element to the question, though, advisors are disclosing information about conflicts, commissions, etc. already, and so that's a requirement on the FAP, and they will be doing some kind of disclosure. So in that sense of disclosing incentives under CoFI and the changes that might bring, I think there will be an element of firms being able to take that in their stride. They know their customers, they know how best to talk to them about these types of things. And in Partners Life, we're trying to do everything we can to help those advisors adjust and look for alternative ways to establish leads or leverage technology solutions, for example, to support existing customers as well as finding new ones. And we're seeing early indications that some businesses are actually already changing their remuneration models. Some are opting for a fee for service, for example, or package solution approaches. I think the incentives piece is quite interesting because when we think about incentives, we naturally think about commission payments and soft incentives. But actually, some incentives, our view is that those can be quite supportive of good customer outcomes. For example, access to specific software or product training. And so I hope that there's an appreciation that incentives don't necessarily mean something bad, because it can actually help. It can help with education for the advisor, which can actually be a good thing for the customer in the long term. So I think overall, it's a kind of a cumulative impact, in my opinion. We've got the regulators trying to help advisor businesses. We've got the product providers trying to help advisor businesses, and we've got advisor businesses already doing a lot of this disclosure and being able to have those good conversations with customers to make sure that they can make informed decisions. And it was really good to hear from Clare earlier about thinking about how much FMA is interested in hearing views and consulting on what these changes look like, because in my view, the good legislation is not ever rushed. We need time to consider what the impacts might be, unintended consequences as well. And so it's almost that if we slow down now and take all of that feedback on board from everybody who's going to be impacted by this new regime, we might be able to speed up later on and for the good of customers in the long term. So I think overall it's a cumulative impact on advisor businesses, but I think it's one that they will be able to take in their stride.
Thanks, Becky. I certainly agree. Oh, sorry, Amy. So I was going to say, I certainly agree with your comment that incentives aren't necessarily bad. It depends on the circumstances. Sorry, Amy.
Yeah, absolutely. I would agree with that too. I agree with Becky in that in most cases, advisors will take CoFI in their stride, as we've seen they've done with FSLA, and really embrace the positive change that CoFI will have on our industry. There is a lot of change happening for advisors, as Becky pointed out, and given the timing of CoFI, I think advisors' focus next year will likely continue to be on embedding FSLA and the changes and effects it's having on their businesses. And CoFI will probably get more attention further into the transitional licensing period. The changes under CoFI probably won't be as fundamental to advisors as the changes, of course, that they experienced under the new advice regime under FSLA. And it's worth pointing out that, of course, the two regimes are complementary regimes, and they are aimed at the same thing at the end of the day, which is our customers. So if advisors are doing everything that's required of them under FSLA, then it's likely that they should have the comfort anyway that they are probably doing everything they need to be complying with CoFI. And Becky also touched on, in terms of those disclosure obligations, being a really good example of that, which, something that's already been met under FSLA. It's probably, I think you mentioned it, Nick, the impact of CoFI on advisors might be a bit less significant now than when the bill was first introduced, given those requirements around the direct oversight of intermediaries having changed as CoFI has progressed through Parliament. And I don't think advisors need to be as concerned about the impact of the bill as they might have been at the outset. In terms of incentives, most of the industry has removed the soft commission type incentives now. So, at AIA, we've also already removed volume and target-based incentives for our individual advisors. But depending on where CoFI lands, some distributors will, of course, need to have a look at that and how that, in terms of where CoFI actually lands on that piece. But at the end of the day, I think, advisors play to the whistle. So until commissions are standardised at an industry-wide level, which obviously isn't something that's currently contemplated by CoFI, there will, I think, continue to be some lack of transparency around commissions generally, which can, of course, lead to poorer customer outcomes. So that's just something to keep in mind for us as we move forward.
There's a question in the Q&A point, which going slightly off piece, but it's possibly worth touching now, which I'll summarise as effectively saying, how successful do you think providers have been at preempting CoFI at the time of implementing FSLA? Do we think we're there now? For further changes to come? Tried too hard and have to pare it back? I'll ask Amy and Becky just on the off chance that it's probably more suitable for you anyway.
I'm happy to start, Amy, if that's all right with you. So when in designing the project, if you like, and the framework that we used for implementing FSLA, we very much were conscious that we knew that CoFI was coming, and actually trying to be considerate and efficient in what we were designing for FSLA, so that it although we didn't know the specifics of what CoFI looked like, we would try not to be doubling up or creating extra when we didn't need to. So we've very much tried to be effective with what we have designed and implemented so that it could be dual purpose. Of course, we don't know what the specifics are going to be for CoFI in some areas at the moment, so we will need to go back and back test that. But we've been very, very cognizant that those two things are connected and have a lot of similarities.
Yeah, and I'd just add to that, we did the same during our processes and looking at all of our processes for FSLA. So we certainly had CoFI in mind during that, and all the changes that occurred as a result of that. Also, we had a real focus on ensuring that we were supporting our advisors as much as possible as well through that process, and part of that was, of course, giving guidance around CoFI and the conduct principles and things, and as I mentioned earlier, bringing those conduct principles through to our advisor agreements was one way, and a practical way in which we were able to achieve that as well.
Yeah, and look, to that I'd add, just to close the question out, that I think that's probably been my experience across the industry. So it's nice to see, generally speaking, people taking the same approach. So as we said earlier, CoFI is very principles-based. Part of that is the concept of fair means something to me and something to you and something to everyone else. So how, in practice, then, do we tell what's fair, and how do you move forward with that? So I'll invite Tim and then Clare to comment on that.
Yes, in the initial draft of the legislation, it was pretty bald as to what fairly meant, and there was no elaboration. As a result of submissions, they've now, in the latest draft, added an inclusive description, which says that a requirement to be treated consumers fairly includes paying due regard to consumers' interests, acting ethically, transparently, in good faith, assisting consumers to make informed decisions, ensuring that the relevant services and associated products that the financial institution provides are likely to meet the requirements and objectives of likely consumers, and not subjecting consumers to unfair pressure or tactics or undue influence. This is very helpful to have this guide, but then unfortunately it goes on and says that subsection 2 does not limit subsection 1. So you're left with a very open-ended sort of definition. This issue is being grappled with around the world. In the UK, they have the similar concept of fairness, treating customers fairly. And there's been some case law where they debate whether the fairness requirements are regarded as being an unruly horse. The courts have concluded that they can interpret what fairness means, but I think the real point about legislation here is that leaving it to the courts to determine and indicate what fairness means is a very poor outcome for people who are trying willingly to comply, and it's in the interests, as Dicey indicated in relation to the objective of legislation to provide law that is certain and clear when drafting legislation, including vague topics like fairness, are not particularly conducive to giving the signalling effect that law is required to do, which is to clearly set out what exactly people should do. A lot of the case law on this has been to interpret fairness in the negative, in other words, to try and work out what unfair is. So I think that may give us some help and guidance. We all know what it is when we see it ourselves, but we might have a different view than somebody else. One of the concerns I personally have in relation to the description that's been added into the legislation that says paying due regard to consumers' interests, I regard fairness as being something that takes account of both sides' interests. And in the initial drafting of the legislation, it was written far more that solely the consumer's interests should be considered. That's been refined to a degree, but still there is no recognition of the balancing of the needs of providers as well as the needs of consumers when in the equation. So in short, I think that this concept is a worldwide trend. New Zealand's probably not going to buck that trend, and obviously in the legislation now, we'd be fighting a battle to reverse it. But what I really think should be done is that legislation, and if not the legislation, subordinate legislation, in other words, regulations, should actually put in a comprehensive description of what fairness means. If financial institutions are supposed to know what fairness means, then it shouldn't be hard for the regulators, the legislature, to write down what they think it means as well. So in the interests of everybody, there would be greater help with greater clarity. I suspect this is going to be left to the FMA to write some guidance that obviously is not binding on anybody, but generally I think it will probably work out in practice in the end, albeit there may be some debate around the fringes.
Thanks. I think Tim's done a good job of summing up very effectively where we are there. And I certainly, as far as his last point on FMA guidance, we do have guidance not on fairness per se, but on good conduct out there at the moment, and that is something that we're looking to update next year to kind of bring together our previous guidance, which was we put out for all financial market participants in 2017, and really update it in line with the conduct and culture reviews that we've done over the last few years as well. So kind of watch this space for that guidance, but that will be broad and not just the intent is certainly for it to align with the CoFI regime, but it will be broad across the Financial Markets Act piece there. But I guess just picking up on a couple of points there that Tim made. I mean, the principles-based nature of the regime does mean that the fair conduct principle is not a statutory enforceable duty. So that itself is the need to establish, implement and maintain an effective fair conduct programme. So that's what we will be looking to as regulators is that conduct program well established, and does it have all the elements, at least, that is within the legislation, as though that non-exhaustive list of pointers that's in the bill at the moment, where it points to what firms actually have to have established as far as the systems and controls and the processes that they have in place. So that's what we'll be looking to as far as our monitoring framework is concerned. But that said, and consistent with the kind of culture change mindset shift that I was talking about earlier, the fair conduct principle, we want to be at the forefront of decision makers' minds, and also frontline around what you do, and to inform how you behave. So that's the lens we'll look to when we're thinking about, is this good conduct in practice, or is it just compliance with that regime? So I think when we talk about fair as the FMA, it's not saying the customer's always right, and whenever there's a complaint, that complaint needs to be absolutely settled in the customer's favour. It's saying, much to what Tim was saying about the balance between not only the customer interests, but actually other interests as well. It is looking through that to say, actually, there are all sorts of considerations that should be taken into account. But a fair outcome, might mean that the customer gets what they need, is right, has what they want. And I think, the use of case law will be, as Tim says, very helpful to show, particularly in the unfair places where that hasn't happened in practice, and people can learn from that. But as I said, what we're looking to do is certainly to try and share more good practice as we see it. So where that is possible for us to do, gather together what we're seeing that's working well in terms of good conduct and risk management, and be able to share that with the industry as a whole, so that everybody can learn together about what this means.
Well, thanks, Claire. So, Steve, you kind of alluded earlier, I think, to the role of technology or options for that. And so, final question before we go to questions from the floor is what expectations do you think will be on the industry to mature risk management, and is there a role for technology in that? And we'll ask Steve and then Becky to comment on this.
Oh, thanks, Nick. I just wanted to touch on something really quick first. Becky brought up regulatory change fatigue. And we do see that a lot, and people are going through that. And granted, there is a lot of change going on. I can also say we've talked to some businesses that are really excited. This is an opportunity for businesses to rethink their business models, to get organized, to adopt new systems, to move into the future. And I think we've talked to 3 different businesses in the last couple of weeks where we just kind of smiled afterwards and said, wow, that's exciting. We haven't really thought about it that way yet. So it does bring about an opportunity, and sometimes change is hard, but think about that mindset and why it's hard and what you can do to make it easier. And generally accepting that this is going to happen makes it a lot easier, and looking at it as an opportunity as opposed to a forced change makes it a lot easier for you to adapt to the future. And there's a lot of exciting businesses that are really approaching it that way. It's going to be a phenomenal few years as the industry changes and shifts. But in terms of technology, I touched on it earlier. You should be focused on what systems you have and how they allow you to service clients and how they allow you to be efficient servicing clients. Likely your world has gotten more expensive. And if you think it's just going to get more expensive this year and then flatten off, that's probably not realistic. So you need to ensure that you're using technology to increase your efficiency in your business. And that's something every business should be able to do. There's incredible systems out there right now that are actually a number of systems out there at really solid price points. But one of the biggest things that we like to see people thinking about is their data and their analytics and how they're assessing their clients on an ongoing basis. And this is right from product providers. Some dealer groups can do work like this, and some of the larger businesses can do work with this. Do you have a data strategy? Are you focused on understanding what your clients' needs are going to be in the future? Do you understand how you're going to manage those at that period in time? And how are you going to deal with them consistently? We're seeing an aggregation of books. We're seeing more clients with individual advisors, and technology is going to allow that to happen and allow you to service those people quite effectively. So I would say, as you're thinking about these changes, it is quite exciting. But how are you going to implement analytics? How are you going to implement data? And do you have quality data right now? The guess would be a very significant number. Well, we've done some work on this, and we've done a few projects in terms of assessing data and risk points in large data sets. There are focus on your data. There's a few holes in a number of pieces of data, but there's also significant learning points that are really exciting, that you can help manage a client over the life of a product or over the life of your services in a really effective, efficient manner.
Thanks, Steve. So I think I've tackled this from a little bit of a different perspective, perhaps not surprisingly from a risk management perspective, because it's a subject that's really close to my heart. I think when people hear the word risk management, they often automatically think it's just about saying no straight away, or being, ultra conservative in your decision making. And I think that it shouldn't be about that. It's not just about identifying where things have gone wrong or might go wrong, or how to mitigate or avoid risk. It's also about supporting a business and the board to determine how much risk the business wants to take, and then using that when opportunities arise so that you can decide whether you're taking enough risk, are you taking too much, too little. And I think that's where the maturity piece probably is required. It's an understanding of what good risk management actually means, that actually means good business, and that good risk management is about balancing risk versus reward. So as risk managers, the way that we should be acting is as trusted advisors to our businesses that we support, and acting as a business enabler whenever we can, really. That's, to support the strategic objectives and goals that business has. Sound frameworks obviously are the basis of that, and those should be tailored to your business, because each business is different. Every business has different goals and objectives and different attitudes to risk as well. At Partners Life, we're often known as an innovative company and quite disruptive. So it won't be a surprise for you to hear that we've integrated technology into our risk management frameworks, and that's how we actually deliver it to the business. We've tailored that technology solution so it's suitable for our business. It's right sized, it's efficient, it's effective, and it also slots into the everyday for people, so that it's not seen as a burden on top of something else. And that's really important. Important because it helps with decision making. In just picking up on something that Steve mentioned about providers and building on this piece about having a technology solution. If you are an outsourced business, which lots of companies in New Zealand are, because we're small businesses compared to some overseas, and might not want to hold those skills in-house, it's also about understanding the risk that outsourced model brings for you. So, understanding, making sure you've got contracts in place, making sure you understand what the BCP arrangements are for your outsourced providers, making sure you do due diligence properly, and that you've got service level agreements. And those types of things allow you then to tap into all that expertise outside your own business, but whilst managing the risk that brings.
Thank you. Well, look, we've got sort of about 6 or 7 minutes remaining, assuming I've got that correct. A couple of questions in the Q&A, which I'll try and wrap up into one without doing disservice to both of them. And that is, how are insurers looking to ensure good conduct when advice is not provided? For example, will agreements require advice to be delivered? And then sort of related to that, which is me shoehorning it a wee bit, is don't advisors therefore run the risk of having to meet requirements from different companies that could be different? And unless anyone wants to volunteer to have a first crack at answering that, I might pick on Tim purely because I figure a sort of a third party might have a bit more experience in seeing the way different people are doing things.
I think if you're taking, for example, an insurance situation where the brokers might be selling the insurance product, there are aspects of this that are responsibilities clearly of the insurer, which include designing the products to make sure that they're suitable. The question about whether the financial insurer needs to be responsible for the broker delivery is the point we've sort of discussed before, and where we've lobbied hard to ensure that the duplication that would have occurred between FSLA and CoFI for intermediaries is avoided, or we're hoping will be avoided with this next round of comment. So I think you can only expect institutions to do the things that they can control, and there's got to be, if there is going to be control of intermediaries, it's got to be practical. and to date, the proposals were impractical. They went too far. They had, for example, one broker having to comply with maybe 50 different fair conduct programs. And so if there are going to be restrictions, and that's why I think we're looking at this all again closely to see what should be done as a result of all of that. That I think might answer the first question. I'll just see if I can find the second one. So I do.
So the second question was how are insurers looking to ensure good conduct? And
I think the point about the good conduct process we're going through here, which is quite important, is that in a way insurers can tailor the fair conduct outcomes by writing their own principles, so it's suitable, and then that'll be judged because it has to be given to the FMA as to whether it's suitable. And then I guess breaches down the track will be as a result of not complying with that program. And so you can get some definition around what things the institution thinks it can achieve practically that strike a fair balance between the interests of consumers and their own personal needs. So in many ways, I think the process that we will go through for this legislation will lead to improvements and will be manageable. So I just missed the rest of that question because it just dropped off the site, so I can't see what that is. But hopefully that answers the question. Others might be able to have something to contribute.
I might jump in really quick on that one. We've seen with kind of other product lines that, yes, you need to know what's in your agency agreements and with your contracts with your providers and meet those provisions. There are, if you look at banks and home loans, banks can be quite decisive and very authoritative in how they deal with that. And they have a lot more power over a smaller financial advisor, that the smaller financial advisor is not really ever going to be able to remediate that or resolve that in their favor. So we would say that you should always know what's in your agency agreements, understand what you're signing up for, and make sure you meet those, because that can be dealt with quite harshly.
Yes, I guess the question was what goes into the conduct framework. If that's sort of the question, then the section of the legislation or draft legislation to look at is the minimum requirements for fair conduct programs in section 446M, and that has a range of things in it. Interestingly, in that there is also a section on fairness design, which potentially expands the scope of the restrictions that might come in the regulations around incentives, and they will effectively require in BE that the designing and management of incentives needs to mitigate or avoid the actual or potential adverse effects of incentives on interests of consumers, so far as reasonably practical. So that's sort of like a different overlapping restriction going to be imposed on incentives. But there's quite a detailed process in there. It emphasises that it's for many of the financial institutions, it's the design of the products and services being provided, the risks, what to do about failures. It's got aspects on training. It's got aspects on supervising and managing compliance. Those may change depending on how far they apply to intermediary. But I think, as Steve said, those aspects, there will be some remnants there and some expectation that in the contracts with outsourced providers, there will be general obligations to provide, fair conduct. There's obligations around communication, or there's requirements around communication and reviewing of the program over time to ensure it continues to provide the benefits that's being sought. So, in answer to that particular question, that's the sort of the content that needs to go into the framework.
Cool. Thanks, Tim. I think with a minute or so left, we probably should leave it there. And I'd like to invite Nadine Terigora, Partners Life COO, who's been sitting here patiently to offer us a vote of thanks.
Thanks, Nick, and kia ora, everybody. Thank you for joining this session. Partners Life is really proud to support the FSC, and especially an important discussion as the one that we've just had. And I'd just like to thank the panellists. It's not easy preparing for these sessions, and especially on Zoom. So I appreciate all the work that you've put in preparation for the session. So thanks very much, everybody, for joining us. We really appreciate it. And Nick, I think you did a fantastic job facilitating. So haere everybody.
I'd like to add my thanks to the panellists as well. Always hard when you get a lot of people who've got a lot to say. But I hope everyone's taken something useful from today's session. You'll see on screen the rest of the conference agenda there. Make sure you check that out and continue to get involved. Thanks and good afternoon, everyone.